Hey everybody, can somebody indicate that you can hear me? It was good.
Can hear you.
Great, okay, cool. So this session is whether your VC fund should stake or run a validator, and I will pass it on to John. John, take it away.
Great, thanks very much. I'm John Fiorelli, regional partner at Kenetic and founder of Myelin. Very happy to have some time today with Alex Felix of Coinfund and Peter Yang of Fenbushi Capital. Guys, if you want to give a quick introduction.
Hey all, thanks for joining us on a Saturday night in New York here. I'm the CIO, Chief Investment Officer of Coinfund, which is a New York-based crypto fund. Been around since 2015 and are very active in both investing and helping early stage projects and decentralized networks get off the ground and grow into big businesses, we hope. And we're very active on the proof of stake side as well. We have an affiliate called Grass-Fed Networks, which does a lot of those activities that we'll be talking about here tonight.
All right, hi guys, I'm Peter. So I work at Fenbushi Capital. Previously, I was at a bank in San Francisco doing credit risk. So Fenbushi Capital was founded in 2015. We invest both in equities and tokens. We're early stage VC. Most of our investments are, we're blockchain agnostic. We do apps all the way to the protocol, so we're pretty full stack. Currently, on the US side, we have 4 people full time. Our primary goal here is to manage our existing investments as well as seeking new investment opportunities.
Great, thanks guys. So today, I mean, we've already been hearing quite a bit from different networks. There's dozens of networks who are now live, who are about to go live. I was wondering if you could share with us what each of you are doing with proof of stake networks, staking, validating, investing. Share with us a little bit about that, and yeah.
Sure, happy to kick it off. We support networks in a number of different ways. Today, I'd say we're active on 10 different networks, and that ranges from validation to things like running Ethereum nodes in order to maintain infrastructure and also serve up on-chain data. So one of the key requirements of operating in the space is also to understand the data that's being kicked off by these blockchains. And for most people out there, it may not matter how many tokens you get from the network, but for us, we also have to account for them and show the income. So in the early days of janky kind of on-chain data, running your own infrastructure also helps to have better access to that. And it also extends to liquidity provisioning. So we'll support some of our investments with capital on-chain and in the early stages in the seed rounds. We do governance and voting. So we're active on community calls. We also do a ton of research around and economic modeling of sort of the crypto economic mechanisms that these networks utilize and use that to give advice to our portfolio companies. I know I saw McLean from NewCipher on earlier tonight and chatted with them about their work block in the early days based on a bunch of work we did with the live peer team previously and how they did a token distribution mechanism called a Merkle mine, which was quite novel and interesting at the time.
So for our side, we began to establishing nodes and values early last year. Currently, we have about a dozen protocols that we support. So for example, Cosmos or VeChain and Ontology are some are more major holdings. For our side, we want to support the teams that are working on these protocols. In the beginning, it's very hard to have an initial amount of guaranteed nodes that are up or validators. So from that side, we tend to try to support them before they launch their mainnet, just to they're comfortable that when they go online, there will be a well-maintained governance system as well as a network that'll be operable. And then, yeah, not only that, of course, we participate in governance and voting on proposals, as well as helping with organizing communities as well as gathering votes to make sure like everyone's participating, just so not everyone just there to speculate. Yeah, so we plan to launch a couple more staking nodes this year. So, but I guess we can share about that later.
For sure. I think a lot of our audience are developers today, and they've been hearing from the different protocols about their strengths. And I know we've heard a bit from some node infrastructure operators as well. I was curious, as investors, from that perspective, how did you think about which protocols to invest in and so much support through governance? What were some of the criteria you used?
Is it a follow-up for Peter or for me?
Alex, you can start.
Okay. First and foremost, how we look at supporting networks is really an investment decision. The proof of stake and validator opportunity can come before or after we make an investment. So we like to maintain flexibility around when we may enter into a network, and it doesn't have to be at seed design stage. It can be later than that. We look for ways of understanding the ROI and value-added service perspective, but by and large, we have made investments sort of full stack. So that's from the base layer protocols to we have a very keen interest in middleware, and these are things like the graph, which serves up kind of querying and indexing functions, NewCipher, which is working on encryption, recently an investment in a company called 3Box that is building pseudonymous data across the web. And we want to partner with these great teams that are working on novel and exciting network opportunities. And how we kind of package up our methodology for looking at new networks is something called like network lifecycle investing. So if the network has not launched yet, we're very much evaluating the team, the design, what they're trying to do. And if the network has launched, we are looking at kind of how is that network bootstrapping? Can we get our hands dirty with the tech? And once it's mature, it may be more of a commoditized opportunity. Maybe we just have a thesis on this being having a huge growth opportunity, and therefore we want to assist in things like governance. We want to buy more assets. We want to get the word out there around what the community is thinking. So governance and voting is one thing, but actually disseminating a message throughout the community, either positive or negative, on directions those companies are taking is very important. So we want to be a voice for the community and for the network, and that's how we tend to think about entering investments flexibly across those three areas. But predominantly, if we help to provide capital at the seed stage, we will follow on through each of those later parts of the cycle.
So for our side, our staking business is mostly revolving around the companies we invested in our primary market. So we typically don't do any secondary or later stage stuff. So for us, we want to support our investments. One way we're doing that, so for example, we invested in Enigma in 2017, but they're launching their mainnet relatively soon. They've been asking us, hey, they are very well prepared for the North American market, but they're not too sure how to attract users in, say, like Asia or China more specifically. So when teams like that have a request, they come to us, and we do our best to help them out. And for example, another protocol we're supporting, even though we didn't invest in our from our primary market perspective, we did help to set up nodes for them, just because a lot of our portfolio companies says, hey, they want to work with this company. So we just end up saying, hey, these guys, they're solid. We want to support them as well as our portfolio company. So we spin up a node for them as well.
Do you help networks go from Asia to, say, North America, the way you're doing it from North America to Asia?
Yeah, so we try to do that on both sides. So last year we launched a partnership with Stake, and that's our goal that we want to be kind of like a gateway to Asia for both North America as well as helping companies from China or other investments that we made in Asia to go to the Western market. So we felt that's a pretty good move for us.
Gotcha. And not to put you guys on the spot, but I'm just kind of curious when you're thinking about this from an investment and a return on capital perspective. What are your goals? Do you have kind of a like short-term, long-term goal, a way of thinking about this?
It's a really good question, and I think it's sort of situation dependent. I think there are networks that have shown traction, and we're constantly watching sort of base layers for activity on top of those networks. So that's very much recognizing that real applications and use cases have not yet developed. So we understand how big that market opportunity could be, and we want to be totally ready for it, and we want to diversify across some of the strongest networks in that vertical. But we totally recognize that it's still very early, and everyone is focused on the supply side of their networks. They're focused on the security of their networks. They're focused on getting all that stuff right, because these are mission critical systems. And once you do get scalability and people building on top, you really can't afford issues. I mean, we saw some issues in the early days with things like Ethereum and the contentious hard fork after the DAO. And even that, it's starting to feel a little bit like, you're driving the Titanic when you're operating one of these networks with a bunch of people on top of it. And, I know that'll get better, and I know iteration will become faster. But even, getting upgrades done, most traditional applications must push new builds weekly, daily, monthly, hourly, and these networks really only have the opportunity to do it on multi-month timeframes in order to get the community behind it, to get all the validators to upgrade their software and to roll it out. So we are watching very closely, but I think the sort of big opportunity within the base layer is still yet to come, and we'll be focused on having access to that data and trying to figure out which one it'll be. On the kind of middleware side and sort of network agnostic side, this is where we think things may take off a bit faster. And we see lots of great companies and value propositions that, regardless of where these applications come, will be key pieces of infrastructure to support them. And we're kind of curious in that regard, and there's really no better way to learn than to be close to these networks and teams that are driving the vision forward and allowing us to learn from them. So a lot of the strategic value you get from being on the test nets, from working closely with those teams, can help inform and create better investment decisions going forward, just from that sort of knowledge base. So it's a good question. You don't always have to be in the seed round. What I love about blockchain is really this democratizing opportunity. We've obviously seen it go from one end of the spectrum and the ICO boom to the other end of the spectrum, and a lot of VCs taking out seed rounds. I'd love to land back with something in the middle where everyone can still have a huge opportunity and from a return perspective, even if they come in at the testnet phase or soon thereafter.
Makes sense. Peter?
Yeah, so for our side, it's very hard to calculate, say, in terms of like reward or revenue before a network is launched. So the networks we support, we have a focus on supporting them long term. We don't plan on shutting down our nodes for any reason at all. So from that perspective, our goal is still to align our interests with our portfolio company, as well as other nodes as well. So in the sense that what we try to do is we try to create a platform where eventually where we have all the nodes or staking services you can think of, and then we try to offer them. So it'll be kind of like a one-stop shop, if you will. So not only have like a staking as a service provider such as Stake or Block Daemon, we're trying to approach have a Binance model where they have all these tokens they have listed for staking, but one limitation is they only have staking services for coins that's listed on Binance. So what we kind of want to do is we don't want to specifically say, hey, we don't like you guys or whatever in terms of staking nodes. So we want to have a platform and then have a place where everyone can choose which network they want to support. And we try to, have a hands-free approach in that sense. So yeah.
Great. I mean, it sounds like you both, as VC, you're getting very close, very early to the networks that you're supporting. You both are also running staking as a service services, and so I guess my question is, are you active in driving delegation, and how active are you in terms of driving community to the networks you're supporting?
Really good question, and one last sort of follow up on the last one too is the goal for us is really to just reduce our cost basis. So when you're looking at the investment, by getting more yield, you're sort of not being diluted and you're increasing your cost basis. So in that regard, we always want to be staking our own tokens. So we're active in doing that if that's an option. We do not seek delegation. We have had validators that are community members or our investors or other folks will want to join. We also have networks, and if I mention the name Block Daemon 10 times from here on out, they really are the best at sort of what they do. And there are situations where networks are commoditized, and there are situations where networks are in their bootstrapping phase, and both those are totally different and bespoke sort of requirements from what running a validator means. And for us, we like to stay close to the protocols, understand, sort of proprietary opportunities or being extremely early there on how to identify, a network we would like to do something on. But, the mission critical monitoring, the term like 6 nines and all the reliability that's required, just can't be done totally in-house. So it's really great to, for those prospective folks out there thinking about becoming their own validator today, to join up with a team, right? So to band together, to find 5 people to do it together with, because all the components just require sort of 24/7 operations, and it's better to do more networks together than it is to do fewer on your own. Right. So that's something we learned. We learned in house is once we got to a certain number of deployments, it was not possible to do that ourselves without a full team. And so leveraging someone like Block Daemon or some other staking as a service provider can really help you scale up your support of networks, and also to spend our time on the stuff that's important to us, understanding the economics, modeling them out, and working closely with the team on bugs we see, on other issues, and it frees us up to do that. So I would say definitely do this in teams and look to make the ecosystem collaborative in your approach. It also helps redundancy, to have people doing different things and helping each other out. So,
gotcha.
Yeah. So for our side, in terms of delegation, we have had a request from some of our portfolios, such as wallets and exchanges, saying, hey, it'd be nice to have a way to be able to connect to the backend to run a validation or staking services, but they either it's not their primary focus, or it's something that they don't have the capacity to do right now. From that front, we tend to try to help out those partners of ours. Even with people who are not having as close of a working relationship, we try to help them out as well. So one of the companies that we invested in also have another co-investor that did not have any blockchain investment, and it's the only blockchain staking related investment they made. So they said they can't really run a node by themselves, and they try to seek help from that end, but they don't know any staking services provider that they're as familiar with. So they say, hey, why not can like Fenbushi help out from that front? So in terms of support networks or driving other delegations, our approach is try to help out our partners and our portfolio company from that perspective.
Right. Yeah. So you're not broadly marketing, but you're trying to help your friends.
A little bit. We do what we can.
Are you just curious in terms of your setup? Are you doing it on prem? Are you doing it in the cloud? Are you outsourcing it? How are you get? I mean, it sounds like you're both really involved. So it sounds like you're doing it yourselves in a lot of ways. Yeah. What's your setup?
Yeah, we tend to see most people doing it in the cloud. Securing hardware is a risk if you're running stuff on-prem. So, when you think of a Bitcoin mining farm, again, the reason why you can't do this stuff alone or as a one-man operation is someone's got to watch that facility 24/7. If you have hardware in your office, someone's got to watch it. So I think a lot of people opt for cloud deployments, even though they are a bit more expensive. And it also gives you better, redundancy and optionality. But again, we do a mix of in-house work as well as, partner very closely with Blockdaemon on a number of the things that they can help support. And I think that's a really good way to go. DevOps, monitoring, tooling, ways of deploying things faster, ways of getting nodes at scale cheaper. All that stuff just makes so much sense to leverage a company that this is their bread and butter. But in general, that's what I've seen. More cloud deployments, and/or if people do have data centers, they'll still want redundancy paired alongside that data center because of the especially on base layer opportunities, the risk of slashing, the risk of going down and being penalized and/or missing out is high. On like applications that have staking, we tend to do a bit more of that in-house, and those are more middleware or applications with staking features where it might be a payment system you're validating, it might be just data that you're propagating and/or validating from a side chain, and those aren't as sort of the risk reward to doing that in-house and having a hiccup isn't as large as it is for base layers.
Yeah, for our side, early last year, we did actually all of our staking services in-house, especially those that deal with custody. But late last year, we also, like I mentioned, we partnered with Stake.us, where they also host a node for us. So, when we're comparing the two different services, having an in-house team definitely offers a lot more flexibility. We can be as comfortable as we want, but on the other hand, the cost is a little high, and we do sometimes we need to be more closely in monitoring our node, as well as, for example, in terms of upgrade or operation, we tend to have to pull resources from other teams and other groups internally just to make sure everything from our staking services is running smoothly, which sometimes it'll be hard to account for financially. So I think when we can, we try to push everything outward to have someone else do the staking for us. But for tokens that require custody in order to do staking, we prefer to still have that done internally as well.
Right. Makes sense.
I think Peter really hit the nail on the head there with the hybrid, because you don't want to not be able to do something that you think is interesting and novel, and maybe be the first to that opportunity. And because you're waiting on a third-party service provider who hasn't deemed it to be a relevant business opportunity for them, so it's lower down on their list or in their pipeline, and you think it's really important to that company and or the economic opportunity to be running day one. So you have to have that flexibility if you want to be sort of an advanced player in the market. But the other comments all ring true, and all sorts of security risks around staking, custody, and stuff like that too.
Yeah, I mean, it really comes down to what networks do you really want to support, and then you have to decide what the best deployment model is, and you make it work. Yeah, I mean, it makes a lot of sense. You both have highlighted some important risks, though, right? So there are some networks that are really attractive but have slashing risks or have other forms of risk. Can you walk us through some of the risks that you evaluate when you're thinking about the networks that you want to support, and also how it affects your investment model, your deployment model?
Yeah, there's a lot to say here. So maybe I'll try to list off a couple, and we can dive.
You don't have to name names or anything. Yeah.
we can dive a layer deeper, but slashing risk is unique to blockchain. When you think about, or maybe not blockchain, but unique to investing in an asset where you can lose units. So when I have on balance sheet a certain amount of units, and all of a sudden I have less units the next month without making a trade, I mean, a traditional fund administrator's head explodes. So we have to think very acutely about how to remedy situations like that if they come up. I think the market has moved towards low slashing risk, at least out of the gate, while they bootstrap security, because it's a big deterrent, right? When you want to build a community around your network, you don't want to be the school where you come to and people are slapping you on the wrist and not smiling at you when you're working your hardest to get your validator up. So it's really important to balance slashing risk for networks that are getting off the ground with an inflation or higher reward, or to really ring fence the risks that are deemed by slashing. Now we have smart contract risk too, right? So smart contract risk is very important, and you might even think about whether or not you want to stake to a network versus lend that token to a centralized provider or on Compound. And those are real incentives at play there. Do I trust their smart contracts more, or am I going to take theoretically the same return but not support the network with my stake? And that's a trade-off I don't want to make, but one you have to diligence and one you have to understand going in. So those are two of the biggest ones. I don't think we've quite gotten to governance risk in terms of being a meaningful component. What we have right now is kind of like monopolies on governance. So we have either an investor or a team that holds so much. I don't know if anyone here was following the Digix vote, but that was about as cool as it gets from a step to maturing around governance. However, the whole vote still came down to one or two whales that didn't really identify or signal, about what their intentions were, and we had modeled out, all the past behavior of all the wallets that held Digix previously and had voted, and the people that turned the vote had spread their Digix out across many different wallets that had no history of voting. So it's a whole space that's evolving, and I think it's really cool. And then, also we'll talk about price risk, but that just goes back to my thoughts and comments around, you got to look at this as an investment opportunity. I think someone else in an earlier panel said, buy tokens and validate on networks you believe in, and if you take that advice, then I think you at least won't be as emotionally upset if the whole thing falls apart. And you're really looking at the validator opportunity as a trade-off, as like, how much does it cost to do this? How much, how much asset am I creating, by doing this? And think about whether or not that opportunity makes sense for you. And so we can chat price risk too.
Cool.
For our side, we have two areas of focus. One is security, the other one is opportunity cost. So in terms of security, of course, Alex mentioned that we don't want to lose any of our tokens. Like if we can just have our tokens staying on wallet the whole time and not generate yield versus potentially losing all of our fund. I think we have to explain to our LPs what we did wrong there. So we from that perspective, we have to at least guarantee that this is the right decision we're making. Aside from losing our fund or price risk, we also have to consider collusion from the block producers or validators. We try to want to participate in networks that are sufficiently decentralized, just so that it's fair for everyone. But on the other hand, in terms of security, we don't really have to worry too much about, as like Digix you mentioned previously, it's a very interesting perspective to see, the founders and the token holders, when the conflict, it conflicts with interests. So from that, we try to not to really have any say in that. In terms of opportunity costs, I think like Alex also mentioned, we can get a yield from staking, but we can also get a yield from lending. So from that perspective, we want to also find a balance point between maximizing our return versus supporting networks. Yeah.
Got it. Yeah, I mean, you guys flowed really well into one other question I had, which is there are other ways to use the tokens you have on your balance sheet or in your fund to make return. And so as you're thinking about lending in DeFi, or whether you're thinking about staking or delegating or validating, what do you have some set of like criteria of how you think about, well, this network I think I want to do, I definitely want to support and be really close with this network, I think I'm just going to take a punt on it and I'm willing to lend it because there's a very frothy market for it. Help us understand how you guys think about it.
Very good question, and probably a couple different ways to unpack it. So, number one is with the explosion of DeFi, there's all kinds of new opportunities, but also new risks. So, we like to think about smart contract risk for sure. So if I'm investing in a DeFi product that then invests in, 5 other DeFi pools, that's, sort of layering of smart contract risk, and it's like compounding. Because now, there are 2 points of failure that if either one breaks, like I'm out. When we think about sort of a new network, coming online, we may want to wait and see, and see it mature for a bit. So there could be, a reason to give things some time to get up and running before you add your whole stake, or you may want to, spread that stake across a couple different venues. So you could lend some, put some on protocol, and lend some on protocol, stake some, and then also lend some to another fund or a third-party provider. But the whole point is that there's counterparty risk everywhere we look, and we need to think about how do we diversify across those different types of counterparty risk. So you're clearly not going to do, one of those 3 things, with every single, token you have. You're going to, want to think about, well, does this one have ether risk? Does this one have Polkadot risk? Does this one have, centralized risk management risk? And, when we think about that, we just have to kick those things around, and we try to assign probabilities to them. So we try and understand, is compound or maker riskier? If I had died, how much would I pay from my yield to actually have that insured? Is it, if it's a 7% yield, would I pay 6% just to make sure that I have no downside risk? And many other ways, to also, think about that. But I'd say smart contract and in the decentralized context, and then looking at each individual counterparty you may be dealing with in the offline context is of paramount importance in how you make any of these decisions.
Do you have an internal risk manager that does all that modeling for you to optimize your decision making, or?
No, I mean, listen. If we had a crystal ball right now, it would be great. I think it's more, we put our heads together with, our technical team and folks that are looking at the smart contracts. We've seen some projects out there that we would have liked to get involved with, but we, upon review of the smart contracts, we got nervous. And then on the economic side, it's like, okay, well, what's going on in the off-chain world? What's going on? With someone like Compound, who's now been around for a little bit longer and has had an asset level that's been sort of stress tested with exploits, and we just need to put our kind of brains together on that and do the best we can, because there's no history here. There's no insurance company that has actuarial models around these things, and if history is a guide, we've yet to see some big calamity, within the smart contract bug in the past 2 years. So I don't want people to get complacent around that risk. It's honestly, I'm surprised it's been so long, but at the same time, it just tells me it's coming again. Whether it was Gox, whether it was the Polkadot multi-sig error, there's all sorts of stuff. So just keep your risk tuned, or antennas tuned in.
So we've heard it here. Alex Felix says that there are some black swans gestating right now that we should all be. It's going to go to press, Alex. What about you guys? How do you think about it?
So for our side, we try to group into 3 different buckets. So we can either do staking, borrow lending, or trading. Each has its own risk. So we think trading probably falls under market risk. Borrow lending falls under credit risk, and staking, we think operational risk might be a better fit. So with any protocols or any tokens, we're not as comfortable, depending on how familiar we are with the conditions. So for us, after we decide to launch a node, how much we put there, we try to evaluate each type of risk individually and see which one we're most comfortable with. So it's not always about maximizing our return. Sometimes it's more about controlling our variances. The more comfortable we are, the more confidence we can go into doing our business that way.
Gotcha. So looking at some of the questions, first of all, I just want to thank everybody who's watching and posting all these really terrific questions. I mean, there's one here that I thought was kind of interesting. Do VC funds typically only support networks that they're in early for, or do you come in later? Alex, you mentioned that there are some networks that maybe you weren't sure about at the beginning, but then maybe things started to look rosier. Do you ever participate on a secondary level, or is everything primary?
No, very, very much so. And it's a great question. We just some examples. We didn't invest in the early rounds of live peer, but once they got to sort of launch, and we looked at the opportunity to get involved in the Merkle mine, which was their token distribution method for technically focused participants. we thought that was really interesting, and we also thought that the outlook for what they were trying to do was quite strong. So we entered the network that way there. We sometimes will want to see a network solve some of the key risks that we have outlined in an early stage assessment. So we have no problem with buying on the secondary. And in fact, when I thought about how do you best operate a crypto fund, not having that flexibility would be crazy to me, because you want to have that optionality. You want to see a great team that you almost got there on prove you wrong, get their network out there, build a community, get some excitement and visibility, and bootstrap the supply side. So a lot of these networks are going to rely on validators such as the people in this audience today in order to work. I mean, I can't tell you how many 51% attacks I've seen now, and the asset prices don't even go down because the people who hold those tokens, have it's I don't know if it's people who just don't care and like overlook it, or if it's people who were just close to the project anyways and don't stand to really lose anything. But it's really important to focus on that and think about that.
So from my perspective, we actually have launched nodes that we didn't invest in our equity or early token rounds. So for example, Cosmos is one. I think it will make sense for investors to stake their tokens. So I kind of see why there's a slight bias in that sense. But on the other end, we also have like investments that we made that we are not actually staking right now because we don't think they have the correct governance or correct setup to the infrastructure ready to be able to have everyone to participate in say a mainnet staking right now. So during testnet, we try to give as much feedback, but when it launches, we think there might be a little bit of work that's needed. We will actually hold off a little bit before we decide to have it staking on day one. For our philosophy is right now it might be too early to say for sure that this protocol is like the best protocol or this will be the one that survives in the end. So and on the other hand, we don't always invest in like the say like the best protocols. So I think we want to keep a level head.
What's the best protocols?
Well, if you look on our website, we have investment listed on
I'm sorry.
our website.
I forgot. The Fenbushi index, right? Yes, that's right.
Yeah. But jokes aside, if we missed out on anything, we don't want to be kind of arrogant and say, hey, that's not good.
Right.
We will support them other ways, not just through like investing in the primary market. So if staking can help, then we'll try to help.
Gotcha. One question that I think has come up for both large validators and small ones is, so far we have a lot of networks who have gone mainnet. We're getting block rewards, so we're getting all these tokens and it represents inflation. Obviously, we'd like to start seeing adoption in fees. How important is that criteria for you, and what are you seeing out in the landscape now that indicates that there's some type of adoption, or are you seeing examples of protocols that are skillfully driving towards building an adoption? What are your thoughts on that?
Really good question, and brings up a lot of potential answers and also probably some axes of analysis. So in the medium term to long term for application-based networks and middleware based protocols, you'll really want to see fees. The sort of asset emission in and of itself will not be enough to support that unless if we go to crypto Twitter and ask about if they get a monetary premium, then maybe we'll discuss that. But why I love the live peer example so much is yes, they're using their token as like a TCR for how you get into the validator set, right? So having more token, gets you into the validator set. But at the end of the day, it comes down to how good are you at transcoding the underlying videos that are being pushed through, and you'll get credit for reliability, for quality, for how much you can do as a sort of resource provider on that resource network, and I think that's really important to the longevity, and those fees will not be paid in the token; they'll be paid in ETH or USDC or whatever sort of underlying fee currency that comes through. So I think it's in most contexts going to be super important, but in base layers it gets a little muddy because Bitcoin pays in block rewards and Bitcoin fees, and you'll see that from a lot of other base layers too. Obviously, you can probably abstract that away, going forward, and people can get paid a fee in whatever token they want and a block reward in the underlying token. So I don't think that would be a terrible model either. But middleware and above in the stack, you're really going to have to not only be relying on your token, because your token should be sort of a way of figuring out how you're rewarding the supply side, right? So figuring out how you're rewarding the back end of that network and the people who are standing it up and making it work for the end users. So there has to be some sort of marketplace dynamic there, and you can't just fully subsidize. You can't just subsidize, forever. So we'll have to see, fees come in, I think, for middleware and up in the stack.
Do you think middleware should be denominated in the native, or do you think it should be stable?
That's again, really good question. I think, there's no real downside risk to trying to build a community around having your own native token, and to jump starting that bootstrapping process where you can at least subsidize with something, because it might be harder to get folks in for the speculative part, right? Where I want to be in that incentivized testnet, I want to be, working day one on your network, but there's no fees yet. Right. So it's catch-22. I think, longer term, I'd love to see great marketplaces and great resource networks that are purely transactional, where you're matching, supply demand, and you brought that middleman cost to zero. But in terms of like, how do you build a community and get the network up and running, I think you need it, or at least there are good reasons for it in that bootstrapping phase.
Yeah, you got to start somewhere.
Yeah, I think Alex made very good points. I'll just add a little bit more. So I think in terms of transaction fees, I'm a firm believer you get what you pay for. So in networks, we've seen networks that don't really need any transaction fees to some that requires either a lot of time or resources. We think maybe having a very high fee may not be feasible to use or user friendly. I think there's a balance point we have to find. Maybe in the sense that we want to have enough incentives for both users and miners to be able to participate in the network. From that perspective, I think in the transaction fee, we think probably none could work, but I think we want to have enough cost so that people actually want to use the network instead of just taking advantage of a network that offers something for free.
Mm-hmm. That's a good point. I was curious, just looking at some of the questions that the audience has shared. One that's come up is, in addition, I know you guys, for example, work with Blockdaemon, with Staked. Are there other validator businesses, other staking as a service businesses that you also invest in or support?
On our side, we have not invested in anything other than Blockdaemon to date. We continue to invest in our own internal operations around how we work in that regard. I think early on, or at least last year, past 2 years, there were a bunch of staking as a service companies. We really wanted to see the marketplace kind of level set around, how much can you earn when you're earning this token denominated yield, and is it possible to build kind of a venture scale business around that? So my advice to folks here would be, the speculative component of networks is awesome, right? I mean, you want to be in there early, you want to be getting the native assets if you believe in it, but also you need to think about your business as an infrastructure service, and think about ways to build in some SaaS revenue, or build in ways that you can offer other services than just trying to go out there and fight for more stake on your validator. So I didn't see a lot of diversification in early business plans around how they plan to move beyond just a sort of delegation based fee, and that's what I would look for when I think about investing in this part of the sector, because at the end of the day, this is like the iceberg underneath all these networks, right? It's actually one of the most critical areas of development that needs to go on. And Google has huge pre-vets, and everyone's busy. Amazon's too busy to focus on it. So there will be huge companies that can build monitoring, DevOps, tooling, redundancy, but it's very specialized. This is unique to blockchain. So everyone here has a huge opportunity to get a piece of that pie. But I do, from our perspective, too many of the early models were built on projections that were solely, sort of speculative token value.
Yeah, for part of the reason we have the hosting in-house was early last year there were a lot of staking as a service provider, and it is just really difficult to say, hey, this is what we want to say for sure that we want to work with to get in forever, and not including like opportunity risk or terms of technical difficulty, because running a node itself, I don't think it will be as challenging we have to specifically outsource it. So from that perspective, we tended to keep an open mind. As we progress throughout the year, I think what we've seen is these staking services provider are staking most of their investors' token, which doesn't really do much for the ecosystem overall, and does not push or move the development process forward. So what we want to see is to have providers that can offer value-added service, for example, like the tooling services. So I think if we look beyond just having a yield, we would like to see a player that can offer more value from that perspective.
What do you beyond tooling? So like Blockdaemon and Stake provide tooling. There are also models where you have derivatives, or what Stake Capital is doing with Stake DAO. Do you look at models like that? Do those look attractive to you?
So go for it, Peter.
Yeah, so I think from in terms of like derivative, there are a couple of new projects that's kind of working on that, especially for protocols that have a longer unlocking period. I think right now it's still a little bit too early to be able to do that either through a decentralized way or overall just to have that kind of service, because DeFi, while is very innovative, I don't think we can achieve the scale that is needed to be able to support all the different networks. So right now, at least I'm pretty cautiously optimistic, but we'll see how it plays out.
Yeah, I also want to make a quick point on alignment of interests, right? So when you have skin in the game in the network, and you're delegating your stake to someone who may not, they have your voice, right? They have your vote now. Obviously, if they set up some form of proxy voting or reach out to their constituents to understand how to vote, but they may not be privy to the commercial and business objectives of the network, and since they're solely service providing it, not holding like skin in the game or capital risk within that network. So we look at that very closely, and I want to see the entire industry move to a model where one, voting is just easier and there's not as much technical friction, but two, that the real people with skin in the game can align their interests and make them work, because you have all these black swan risks associated with that too. I mean, Peter's mentioned derivatives. You have weird lending situations where someone could theoretically hold 51% of the network without having actually purchased it in the open market. If I just go out there and say, here's 15% yield on a network that's not paying anything at the base layer, is not paying, is paying 1% crypto economically, everyone's going to stake to me. And all of a sudden everyone stakes to me and I'm like, oh, well, I actually want this network to die because I bought a bunch of derivatives. So, there's all these kind of risks that'll come up, and people should be thinking about it now.
Gotcha. I guess the last question, we have a few more minutes. I think the last question I'd want to ask is, how much decentralization would you like to see in the networks that you're supporting the most? And you can quantify it however you want to, because obviously there's percentage of circulation that's staked, and then there's how much of it is, what's the distribution curve across different validators. How do you think about decentralization as a dare I say, a key component of a network?
We looked at that from a couple of different perspectives. So for example, like if we look at Gini index, you can kind of there's I guess more objective way to measure how decentralized or centralized a network is. I think as long as the network is the centralization is not too extreme, we don't really have too much of a I guess like we're not that opposed to it, because again, right now it's still too early to say what is the correct method. If we just looked at like within this year, there are different ways that people are trying to either think about like proof of stake, how we want to change or develop. So I think right now, in terms of decentralization, we still have, even though there are different ways to do it, I think right now what we want to do is keep an open mind. As long as it's not too extreme, we're fine with it.
And very, very quickly, it's, we want to look at geographies, see it's spread amongst those. You want to look at back-end infrastructure and understand that these are on different cloud providers or different servers. You want to look at, sort of the amount of validators that are allowed in the network and or participating and trying to participate, and many other factors. So I think it's an ongoing experimentation. My partner Jake looks at kind of a Bonds-Hop analysis on governance voting. So there's like technical decentralization, and then there's economic decentralization, and both those things will definitely have to will improve over time, because it's not great right now.
Awesome. Well, we are just about out of time, and I just want to thank all of you for joining, and John specifically for the incredible questions. But thank you so much, and we have to move on to the next panel. Thanks again, everybody.
Thank you.
All right.
See you.